Hey traders, and welcome to the 5th video in this trading course where we will be covering oscillators. This will include 5 different chapters: definition and types of oscillators, relative strength index, stochastic oscillator, moving average convergence divergence, and lastly the relative vigor index. So let's dive straight into the definition and types of oscillators. Oscillators are a popular technical analysis tool used by traders to measure the momentum of a security and identify potential areas of overbought or oversold conditions. In this chapter, we will discuss what oscillators are and the different types of oscillators commonly used in technical analysis. Oscillators are indicators that fluctuate between two values, typically 0 and 100. They measure the momentum of a security by comparing its current price to its historical prices over a certain period of time. Oscillators are typically displayed as a line chart with values plotted between the two extremes. There are many different types of oscillators used in technical analysis, but the most common ones are Relative Strength Index. The RSI is a momentum oscillator that measures the strength of a security's price action. It compares the magnitude of recent gains to recent losses to determine if a security is overbought or oversold. Stochastic Oscillator. The stochastic oscillator is a momentum oscillator that compares the current price of a security to its price range over a certain period of time. It uses two lines, %K and %D, to measure the strength of a security's trend and identify potential areas of overbought or oversold conditions. Moving average convergence divergence. The MACD is a trend-following oscillator that measures the difference between two moving averages. It uses two lines, the MACD line and the signal line, to indicate potential buy or sell signals. Relative Vigor Index. The RVI is a technical analysis indicator that measures the strength of a security's trend. It uses two lines, the RVI line and the signal line, to identify potential buy and sell signals. In conclusion, oscillators are a useful tool for identifying potential areas of overbought or oversold conditions and measuring the momentum of a security. By identifying the different types of oscillators and how they work, traders can use them in their technical analysis to make informed trading decisions. Next up, the Relative Strength Index. The RSI is typically calculated using a 14-period time frame, but it can be adjusted to suit a trader's individual needs. The RSI is displayed as a line chart that fluctuates between 0 and 100. When the RSI is above 70, it indicates that a security is overbought and potentially due for a price correction. When the RSI is below 30, it indicates that a security is oversold and potentially due for a price rebound. Traders often use these levels as potential buy or sell signals. Another way traders use RSI is by looking for divergences. A divergence occurs when the RSI is moving in the opposite direction of a security's price action. For example, if a security's price is trending higher but the RSI is trending lower, it could indicate a potential trend reversal. However, it's important to remember that the RSI should be used in conjunction with other technical analysis tools and not relied on solely for trading decisions. It's also important to consider other factors such as market conditions and news events that could affect a security's price action. In conclusion, RSI is a popular and useful technical analysis tool for measuring the momentum of a security and identifying potential areas of overbought or oversold conditions. By understanding how to use RSI, traders can make more informed trading decisions. Next up, Stochastic Oscillator. The stochastic oscillator is typically calculated using a 14-period time frame, but it can be adjusted to suit a trader's individual needs. The %K line is the main line and the %D line is the smoothed version of the %K line. When the %K line is above 80, it indicates that a security is overbought and potentially due for a price correction. When the %K line is below 20, it indicates a security is oversold and potentially due for a price rebound. Traders often use these levels as potential buy or sell signals. Another way traders use stochastic oscillator is by looking for divergence. For example, if a security's price is trending higher but the stochastic oscillator is trending lower, it could indicate a potential trend reversal. It's important to note that the stochastic oscillator can produce false signals during periods of low volatility or when a security is trading in a sideways pattern. Traders should also use stochastic oscillator in conjunction with other technical analysis tools and consider other factors such as market conditions and news events that could affect a security's price action. In conclusion, stochastic oscillator is a popular and useful technical analysis tool for measuring the momentum of a security and identifying potential areas of overbought or oversold conditions. By understanding how to use stochastic oscillator, traders can make more informed trading decisions. Next up, moving average convergence divergence. The MACD is typically calculated using a 12th period and 26th period moving average, and the signal line is a 9th period moving average of the MACD line. Traders look for crossovers between the MACD line and signal line, as well as divergences between the MACD and price action to identify potential trend changes. When the MACD line crosses above the signal line, it's considered a bullish signal and indicates that a security's price action is likely to continue higher. Conversely, when the MACD line crosses below the signal line, it's considered a bearish signal and indicates that a security's price action is likely to continue lower. Traders also use the MACD histogram to identify potential trend changes. When the histogram is above the zero line, it indicates that the MACD line is above the signal line and suggests a bullish trend. When the histogram is below the zero line, it indicates that the MACD line is below the signal line and suggests a bearish trend. It is important to note that the MACD is a lagging indicator and may produce false signals during periods of low volatility or when a security is trading in a sideways pattern. Traders should use MACD in conjunction with other technical analysis tools and consider other factors such as market conditions and news events that could affect a security's price action. In conclusion, MACD is a popular and useful technical analysis tool for identifying potential trend changes and momentum in a security's price. By understanding how to use MACD, traders can make more informed trading decisions. And lastly, the Relative Vigor Index, otherwise known as the RVI. The Relative Vigor Index was developed by John Ehlers and is often used in conjunction with other technical analysis tools to confirm trend signals. The RVI is calculated by taking the difference between the opening and closing prices and comparing it to the difference between the high and low prices for a given period. This calculation is then smoothed using an exponential moving average to generate the RVI line. Traders look for crossovers between the RVI line and the signal line, typically a 9th period EMA of the RVI line, to identify potential trend changes. When the RVI line crosses above the signal line, it's considered a bullish signal and indicates that a security's price is likely to continue higher. Conversely, when the RVI line crosses below the signal line, it's considered a bearish signal and indicates that a security's price is likely to continue lower. It's important to note that the RVI, like all technical indicators, is not perfect and may produce false signals during periods of low volatility or when a security is trading in a sideways pattern. Traders should use RVI in conjunction with other technical analysis tools and consider other factors such as market conditions and news events that could affect a security's price action. In conclusion, the Relative Vigor Index is a useful technical analysis tool for identifying potential trend changes and momentum in a security's price. By understanding how to use RVI, traders can make more informed trading decisions. That is it for this video on oscillators, guys. Be sure to have a clear understanding of these types of oscillators as they are extremely popular and useful amongst traders. See you in our 6th video where we will be covering Japanese candlestick patterns and why they are so widely used by traders around the world. This is something you don't want to miss.